The Indian rupee has crossed a line markets had been nervously watching. On Thursday morning, the currency slipped to a record low of 92 against the US dollar. It opened near 91.99, weaker than the previous close of 91.78. The move confirms what traders have been warning about for weeks. Pressure on the rupee is no longer building quietly, it is now visible and persistent. The immediate backdrop is global. Asian currencies are under stress as the US dollar stages a recovery. But India's problem is also homegrown. One of the biggest drags on the rupee has been heavy foreign selling in Indian equities. Nearly $4 billion have flowed out in January alone. That means fewer dollars coming in and more demand for dollars going out. This pressure has grown steadily, not suddenly, making it harder for the rupee to regain balance. Last week, the rupee fell more than 1%. That speed matters. Traders say fast declines change behavior. When markets see momentum, they stop betting on stability and start pricing in more weakness. That is exactly what has happened as the rupee edged closer to 92. Expectations are now feeding the fall. As the rupee weakens, importers and investors rush to buy dollars early. They fear higher costs later. This front loading of dollar demand adds pressure even on days when global cues appear supportive. It comes a self-reinforcing cycle. Companies are also reacting. Bankers say firms have stepped up hedging to protect against further currency losses. Hedging requires dollars through forward contracts and swaps. When many companies do this together, the demand spills into the spot market and weighs on the rupee. Speculators have played a role too. Long dollar positions have increased. These are momentum trades. They follow trends rather than fundamentals, and such positions tend to cap any rebound and keep the currency under stress. There is also pressure from trade flows. Gold imports have picked up. Bullion buying increases dollar demand directly. This channel works independently of stock market and can continue even if capital flows improve. The Reserve Bank of India has not stayed on the sidelines. Traders say the RBI has intervened regularly to smooth volatility. It is supplying dollars at multiple levels instead of defending a fixed rate. This has prevented panic moves but has not reversed the broader slide. There are a few supportive signals. The dollar index has softened to near a 4-month low. The Japanese yen has strengthened. There is unease in the US over fiscal risk and President Donald Trump's policy direction. 1-month forward markets suggest some near-term stability. Policy support has helped sentiments too. The RBI has announced over $23 billion in liquidity measures, including a major Forex swap. India and the European Union have also concluded talks on a landmark trade deal offering longer-term comfort. But traders remain cautious until equity outflows slow and dollar demand from hedging and imports eases. The rupee remains vulnerable. For India, the message is clear. The 92 mark is not just a number, it is a signal that currency stability will remain under close watch in the days ahead.